Money in itself is an institution, as its value derives from the metaphysical. It can only exist as long as people trust in it and accept it in exchange for goods and services. Also, since the world went off the gold standard, money is unrelated to the value of any physical quantity. Money today exists as fiat currency, which means that its value is defined only through government law and regulation. Because the value of money has no fixed reference, it can be greatly manipulated by simply inventing more money. There are three basic characteristics of the contemporary economic functioning of money, which show the inherent corruption of today's monetary paradigm. Firstly, money self-replicates. In addition to the possibility to gain money by investing capital, by simply depositing money in a bank account, more money is being generated through interest. The more money you have, the more money is being created. As money self-replicates, so does debt. And the more debt you have, the more debt is generated through interest. Through this mechanism, money is continuously transferred from the poor to the rich. Secondly, money decouples the economy from true resource efficiency and introduces cost efficiency. This means that the value of any economic action is not measured in its potential to benefit mankind, but rather in its monetary wealth output. As a consequence, obsolescent goods are produced as it is cheaper to focus on quantity rather than quality, which results in massive amounts of waste. Often, these goods are shipped vast distances across the globe, wasting huge amounts of energy simply because it is cheaper to produce, process, and package them in different locations. Also, because it is more profitable to utilize existing technology and infrastructure rather than investing in the development and construction of novel industrial means, progress which has the potential to create real wealth and sustainability is heavily restricted. Thirdly, the necessity of monetary exchange creates artificial scarcity. Many different types of goods and resources which could be made available in high abundance are kept scarce in order to maximize profits. Depending on the type of commodity, this is achieved through different scarcity driving mechanisms. For instance, renewable energy could be produced in higher abundance and much cheaper than energy from fossil fuels, considering external factors such as pollution, health issues, risks, and the maintenance of military forces needed to defend and conquer resource deposits. However, this technology is kept from being introduced as a major power source as its availability cannot be as easily controlled and charged for. An abundance of medicine, which could save millions of lives every year, cannot be achieved as prices are decoupled from production costs by the introduction of scarcity through the concept of patents. Similarly, software which could theoretically be distributed without any additional costs is kept scarce through the introduction of copyright. Limited resources, such as diamonds or oil, can be hoarded or even destroyed to limit supply and increase profits. The scarcity driving mechanism for most manufactured goods are obsolescent production techniques. The introduction of automation, which could multiply efficiency, is inhibited due to the necessity of employment based on the economic dogma of wages. Many commodities obtain their monetary value through such scarcity driving mechanisms, which ultimately eliminate the possibility of their abundance. Due to these simple principles, which underlie the entire monetary paradigm, it would be an inherent contradiction to our economic system to strive for equal wealth distribution, efficiency, and an abundance of goods. The original function of the banking system is to take deposits and give out loans. This ensures, on the one hand, the safekeeping of private money possession, and on the other hand, the stimulation of innovation and growth by investing in enterprise. That way, capital is stored for those who don't need it at the time and transferred to those who can make use of it. However, this simple banking principle has been vastly distorted to the point where whole economies are threatened due to miscalculations or fraud in the financial sector. Besides storing and loaning money, a central role of the banking system is the process of money creation. In the current banking system dominant throughout the world, money is being created through loans by the means of interest and fractional reserve banking. Fractional reserve banking enables banks to loan out a multiple of the capital which they actually have available in deposits. Since it is highly improbable that depositors retrieve so much money at once that their combined withdrawals exceed a certain threshold, banks may give out any amount in loans as long as they keep the required reserve. In the United States, the reserve requirement is set to 10%. This means that if a bank possesses 100 million in deposits, it can theoretically give out 900 million in loans. If a loan is given out by a bank, it must always be returned with an additional fraction of that loan known as interest. If we take a look at the simplified deposit loan model, it becomes clear that the money charged as interest is not part of the equation and must be created out of thin air. Money, which is created from nothing, has the same value as the existing money. Therefore, the new money must receive its value from the money pool. This, of course, lowers the value of currency and is known as inflation. The concept of this money creation system is therefore only sustainable in an economy which continuously grows and accelerates cyclical consumption by decreasing the costs of goods and services, which counteracts inflation. However, to base an economy on the expectation of continuous, endless growth on a finite planet must be considered ill-advised at best. All money is created through individuals, businesses, or governments going into debt to commercial or central banks. This implies that all money, which is essentially the lifeblood of our economy, is actually created out of, and therefore equals, debt. As new money can only be generated through more loans, creating more debt, it is impossible for humanity ever to be free of debt. This is fairly convenient, as debt produces pressure which makes it much more likely for individuals to accept a labor for money contract they would otherwise refuse. The generated scarcity of the money supply, which is constantly expanded by interest, forces the population into servitude. This ingenious scam for social manipulation could therefore be termed economic slavery. The madness of the financial sector does not stop at the mechanism behind money creation, but takes new dimensions if one introduces the stock market. The original purpose of the stock market is similar to that of the banking system. By selling shares, a company can raise money from private or institutional investors and utilize it for their own enterprise. Therefore, stocks are the equivalent of loan contracts given to private investors. In this way, the rate with which a company and therefore the economy grow can be accelerated. This, however, raises an important question. Which enterprises are actually being backed by the stock market? Any stock trader must focus only on the potential of a company to create profit, which in turn raises the value of his or her shares. As stated before, corporations are entities which strive primarily for profit maximization. One reason why they act profit-orientated without any regard for human life ground is due to the obligations to their shareholders. No matter how moral of a person the CEO of a big company is, he or she is forced by the system to act in the interest of monetary profit, as he would otherwise lose his occupation. The buying and selling of stocks is only the simplest of activities conducted by the stock market. With the trading of derivatives, the stock market enters a whole new level of complexity. Through the invention of such constructs as credit default swaps, the initial idea of the stock exchange to assist the growth of the economy becomes distorted into global gambling. Investors taking part in this gamble become decoupled from the real-life consequences of their actions, focusing only on their own financial gain. People may lose their life ground and economies may collapse as a consequence of what is initially an unnecessary construct, creating nothing but disproportional wealth for a very few.